Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we're back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Managing Director and Head of Technical Strategy, Chris Verrone. Chris, how are you doing today?
It's great to be here, Ross. Thanks for having me again.
Yeah, thrilled to have you back on. We're at an interesting time in markets, a nice rally, and some of the signposts that it could be a new bull market are flashing, right? Really impressive breadth, a lot of participation in stocks on the way up, but a leadership picture on the sector side that is a bit mixed, right? You all noted utilities, which are traditionally defensive, have been rallying quite strongly. So I want to turn it over to you, kind of with that table set. What do you make of this market, and where do we head from here? How do we position for this sort of environment?
Sure, Ross. It's a great question, and I want to go back and revisit to something I said to you last time I was with you a couple of weeks ago. We said, okay, what are the ingredients or the signs or the tells that would tell us a bounce is more than a bounce, but really the start of a new bull market? And we talked about number one, an expansion in breadth and better momentum. And I think we can check that box, right? A lot of the technical indicators that we look to, a lot of the momentum indicators we would look to have really fired over the last week or two. So I would put a check next to that box. The other two ingredients, pro-cyclical leadership, risk-on type leadership, and some cleaning up or some easing in the macro conditions that have plagued the market all year, were also two necessary ingredients we wanted to see. On the leadership front, I still say it's very, very mixed here. We like the improvement in industrials. We like the improvement in discretionary. But the persistent strength from something like utilities is historically very, very odd in the early innings of a new bull market. You just would not expect to see utilities lead and keep up with the market as they have over the last couple months. So we're about 40 trading days off the June lows, and utilities are up about 18%. They're the first sector to have made a new cycle high in these last 2 months as well. That's just unusual historically. It's still very defensive late cycle leadership. And then on the macro front, we are perplexed that the yield curve is still very much inverted here. Twos and tens as we speak this morning are about negative 45 basis points, which is historically at odds with what you would expect in the early days or early innings of a new cycle bull. So we like the momentum. I certainly want to respect that. I think we have some more work to do on the leadership front and some more work to do on the macro front. I think you add all that together, we've had a big rally here. We're back at the 200-day. I think we should be a little bit careful. I'm not sure if we have to go back and re-see these lows, but I think exercising some caution with a market into resistance makes some sense to us.
Absolutely. That is a perfect summation of the point we find ourselves at. You mentioned the macro front, talking about yields a little bit. Short-term yields and even really, intermediate-term yields, the 10-year, have proven pretty sticky despite what I think is a market rally that's predicated on the idea of peak inflation and a Fed pivot next year. How do you kind of square those two items? Do you think one cracks before the other? Are you not believing one? How do you think about that sort of thing?
It's a great question. And as we wrote this morning to our clients, we said the bond market, no one told the bond market about peak inflation or peak yields, because the way 2-year yields behave and even 10-year yields behave, I think is inconsistent with the idea that we've put some meaningful top in the trajectory of inflation. You have 2-year yields this morning basically at new cycle highs up through about 335. And I think somewhat paradoxically, what was perceived as the soft CPI print last week actually put the low in 10-year yields. We've seen 10-year yields trade from about, call it 250, almost back to 3% over the last couple of weeks, kind of as we've gotten past that soft CPI print. So I don't think the bond market is necessarily on board with this idea that the inflation data has permanently changed direction. We see it globally as well. You've had some very big move in global yields over the last couple of days. The UK move in particular has been very intense. You had new highs in UK 2-year yields this morning. So I think the global picture also suggests the idea that the bond market is not sold on this idea of peak inflation.
Absolutely. All right, I want to end with one question about a sector that we've talked about a lot over the past 12 months, energy. So energy prices have come in. It's been a big reason for some of the softer CPI data. But I still think there's a story to be told about a structurally tight market on the supply side. What do you make of energy, which has been quite volatile over the last say 3 months?
we'll make three observations. I think the first is just a little longer term perspective. Let's still remember energy is the best performing S&P sector this year, even after its correction of the last several months. So we're believers in long-term momentum. I still think energy retains some long-term momentum here. I think the second thing I would point out is while you've seen crude oil prices make new lows over recent days, back below 90, flirting with $85, natural gas is actually making new highs here. So you're seeing this divergence open up between the gas market and the crude market. And then I think third, also despite oil kind of weakening here or near new lows, the energy stocks are actually not making new lows. So the energy equities, I think, are telling us that they can still be profitable and still be good stocks or good investments, even as the price of oil has come back down to the mid-80s. What we've also noticed, if you look at the forward crude contracts, so crude price 24 months in the future or 36 months in the future, those have not gone down as much over the last several weeks. So I think the energy market, the forward curve of the energy market, and the strength or the resiliency from the energy equities would suggest, I think, as Ross, as you point out, there are still some big structural tailwinds for the sector moving forward.
That's tremendous context, and I think we really appreciate it. I know I do. Chris, thank you so much for the time, as always, and hope to talk to you again soon.
Great to be here. Thanks, Ross.